The S&P 500 recently hit another new all-time high, and in fact, this is the 31st record high of this year. So clearly, we've been in the midst of a massive bull run over the last few years. But what's interesting about this is when we actually start taking a look at the valuation of the S&P 500. For example, we can see over about the last 30 years, the average S&P 500 PE ratio is about 16.8, but right now it's sitting at about 22.8. And here's what's even more interesting. The top 10 companies in the S&P 500 make up 40.4% of the S&P 500's market cap. This is why we're hearing more and more analysts talking about the potential of there being a bubble. But in the midst of all this, I'm seeing a lot more insider buying with smaller companies. For example, I've seen quite a bit when it comes to REITs. Now, REITs are a very interesting asset class, as you may already know. For example, over the last 3 years, the returns have been pretty bad for REITs. The S&P 500 is up by about 80%, but Vanguard's real estate index 3-year return is only about 14%. So because of that, they're a way out of favor asset class. But what's interesting is from 2002 to 2021, REITs were actually the best performing asset class. So even in the midst of this REIT sell-off, we've seen quality REITs continue to grow their adjusted funds from operation, which has undoubtedly helped their valuation. And now REITs are trading at one of their most interesting valuations really in decades. So in this video, we're going to be looking at 3 different stocks that have recently had insider purchases, with a few of them actually being real estate investment trusts. So let's go ahead and dive into it. Now, the first stock we're looking at is Simon Property Group. We're currently looking at them on Forecaster, which you can check out at the link in the description. But if we actually look at how this REIT has performed over the last 5 years, it's up about 163%. So it's been a huge outperformer in the last 5 years. And if we look at the dividends charted out during that time period as well, it's interesting to see the dividends have grown, the share price has grown along with it. Now, if we start to narrow this down and look at this stock this year to date, it's only up by about 2.66%. There's obviously been a lot of volatility, especially during the tariff scare, but the stock has essentially traded flat during this time period. Now, again, this is a REIT, so typically they pay out pretty large dividends because they're required by law to pay out 90% of their earnings in the form of a dividend. And we can see that starting dividend yield for Simon Property Group right now is sitting at about 4.74%. So that's a pretty nice dividend payment. And if we look at the dividend history for this REIT, what you can see is they do have a history of trying to grow the dividend, but it's clear they reduced the dividend pretty significantly in 2020, like a lot of REITs were forced to do. But since then, they have been growing the dividend. Now, what's interesting is looking at the insider purchasing of SPG over the last few months. The first thing that stands out quite a bit is we can see multiple insider purchases on September 29th from different directors of the business. Now, why would this be the case? Well, anytime you see multiple purchases like this from different insiders on the same day, more often than not, it's going to be planned purchases. And some people don't think this is as big of a deal, but this is still actually positive for the company. When we talk about stocks or REITs or really any type of investment, we always want to make sure incentives are aligned. So it's always a good sign when management or directors have a stake in the business. But even on top of this, we can see one-off purchases in the last few months from directors as well. So there's undoubtedly correlation with the fact that insiders have a stake in the game, and the REIT has performed very well in the last 5 years. Now, if we jump over to their 2024 annual report, you can see one of the reasons the REIT has done so well in the last 5 years. We can see revenues are growing. We can see funds from operations on a per share basis are growing. And like we've already seen, the dividends are growing as well. But again, the REIT is still flat over the last year. And in fact, if we really zoom in, we can see in the last month, there's been a bit of a sell-off. Part of the reason that we've seen the REIT be a little more stagnant in the last few months is because of the 2025 guidance they gave in their recent earnings report. We can see they stated the company is increasing its outlook for real estate funds from operations to $12.45 to $12.65 per diluted share. So yes, they increased their outlook, but we need to put that into perspective of where they were previously. Obviously, when it comes to REITs, we want to see growing funds from operations. And if we look at where they were at the end of 2024, they were at $12.99. In 2023, $12.51. So even after increasing guidance, what they're essentially saying is they expect funds from operations in 2025 to be lower than the previous year and potentially even lower than it was in 2023 as well. That's not what we want to see. But here's the good news. If we go over on Dividendology.com and pull up the Dividendology database, one of the things I track is in-depth data on REITs. This is data that's very difficult to get that a lot of softwares don't provide. And one of the things I track is not only adjusted funds from operation per share history, but projections as well. And what we can see when it comes to Simon Property Group, SPG, is yes, 2025 projections are showing a decrease in adjusted funds from operations, but they're projecting that it'll grow at a pretty healthy rate through the year 2029. They should get back to positive growth in 2026. So when we look at Simon Property Group on the database homepage, what we can see is the 2025 to 2028 AFFO per share projected compounded annual growth rate is about 3.76%. That's actually very healthy for a real estate investment trust, and it should continue to hold up the dividend growth that this REIT wants to see. Now, with that being said, in the short term, we can see this decline in AFFO per share is leading to a higher valuation for the REIT. So historically, it looks like they've traded in the range of about 11 to 15 when it comes to the price to AFFO valuation. And right now, based off the 2025 AFFO projection, they're going to be trading at essentially their highest valuation since 2016. Does that mean the REIT's not attractive? Not necessarily. Keep in mind, like we saw, they have a very nice starting dividend yield, close to around 5% currently. They're projected to grow adjusted funds from operations at a healthy rate, and they have been growing the dividend. They have historic nice returns, and insiders have been buying. So Simon Property Group, definitely a REIT to have on your watch list. Next on the list, we have Armada Hoffler Properties. This is not a popular REIT, and we can see why over the last few years. Look at the correlation between their dividend payouts and the share price. In the last 5 years, the share price is down by about 26%, and that's because the dividend was cut significantly. In the last 3 years, down 35%. And if you look at just this year alone, look at the correlation between the share price dropping and the dividend cut. That's usually how it goes for REITs. Now, the dividend has been stable since around April, and the share price has fluctuated in that range as well. But there's been a lot of insider buying of this REIT over the last few months. Let me show you what I mean. Now, most recently, we had an insider buy in early October, but we also saw an insider purchase this summer and then significant insider buying in early April as well. Along with that, we saw quite a bit of insider buying in mid-March also. Now, the majority of these insider buys were purchased a little bit above $7 per share, and we can see this REIT's currently trading just a little bit below that, around $6.80 per share. So right now, you can get in lower than insiders. Now, this REIT is yielding a very large amount. It's between about 8 to 9%. And if we look at the seasonality, you can see just how bad this year has been compared to the past 5 or 10 years. So what's been going on with this REIT? Why are insiders buying? Why is the REIT down so much? Well, the obvious reason for why the REIT is down is because of how much that dividend was reduced earlier this year. It's interesting to see the direct correlation between the dividends being paid out by a REIT and what's actually going on with the share price. We saw that was the case for Simon Property Group as well. But if we dig into Armada Hoffler just a little bit more, it's definitely not your typical REIT. So most REITs are just going to buy buildings and collect rent, but Armada Hoffler often develops them from the ground up for itself and sometimes for others, and this does provide some unique opportunities. For example, in strong markets, they can develop and retain high quality properties at below market cost, so they can capture both development profits and long-term rental income. But then on the flip side, if they're in a weaker market, Armada Hoffler can still generate revenue by building projects for other companies, helping them to stay profitable even when real estate deals slow down. So it's definitely unique in that sense. Now, with that being said, the REIT did recently cut its dividend by about 30%. That's a significant amount. And this was a fairly predictable dividend cut because the AFFO payout ratio climbed well above 100% by the end of 2024. We can see in the green charted out. Remember, when it comes to REIT, adjusted funds from operations have to cover the dividend, and we can see the AFFO payout ratio climbed all the way to 115%. So clearly the dividend was not sustainable, and as a result, they cut it. But management noted this in a recent earnings report, that after the dividend, the payout is now fully covered by property income without any consideration of fee income. Now remember, the fee income, that's coming from the construction side of the business. So previously, they were having to rely on this fee income to actually pay out the dividend, but now the dividend is completely covered strictly by rental income. That's a significant shift for this company, and it's a good sign. Now, what's interesting is if we look at the Dividendology database and look at Armada Hoffler properties, what we can see is, yes, the past year has been bad, and adjusted funds from operation is actually negative over different time periods because of how poor the last couple of years has been, but there's not really any forward-looking projections. And that's really because the strategy of this REIT is completely changing this year, as we're seeing, as it relates to the dividend, as it relates to fee income covering the dividend, and in fact, they even have a new CEO right now. So it's become increasingly difficult for analysts to actually make projections. But this is one of the many reasons that I love to see insiders buying right now, because the insider purchasing in 2025 for this REIT has been very significant. On top of this, the REIT is now trading at one of its lowest price to book ratios in the last 3 years. And then finally, we have Cal-Maine Foods, and in the last 5 years, they have performed extremely well. We can see they're up about 144%, and almost like always, you can see the direct correlation between how net income has grown and how the share price of the business has grown as well. You can see the same is true for sales. Now, if you aren't familiar with this stock, what exactly do they do? Well, let's use the Forecaster AI agent to explain. Cal-Maine Foods is the leading egg producer in the United States. And one of the things that's so interesting about this business is they maintain a zero debt position. And this is very important for this company, and I'm going to show you why. Because this business essentially all revolves around eggs, they're very reliant on what the actual price of eggs looks like throughout the years. For example, this is the price of eggs over the last 5 years. You can see there has been some massive fluctuations. I mean, it's gone all the way from around 1 up to 8 at one point. So the price of eggs basically 8x'd in a very short period of time and then came all the way back down. Obviously, this has a major impact on the margins and the profitability for Cal-Maine. And so because of that, this business can be somewhat cyclical in its earnings. And as a result of that, the dividends can be somewhat cyclical. For example, let's scroll down and we can see the dividend payouts over the last decade or so right here. There's been a lot of fluctuations. The dividends will grow, then they'll shrink, then they'll grow even higher and shrink back down. That's just the reality for this business. Now, while we're down here, just take a look at the insider buying. Historically, this stock has seen a lot of sales in the last year, but in early October, we saw significant insider purchasing. Now, Forecaster currently has the dividend yield close to 9%, but it could certainly be a little bit lower on that depending on what type of dividend policy that the company's actually going to put forth. That's part of the problem with these cyclical businesses. It's hard to actually know what the dividend yield you're going to get is because the dividend fluctuates so much. Now, the stock recently released its Q1 results, and it was pretty phenomenal. All their key profitability metrics were up significantly year over year. Net sales up over 17%, gross profit almost 26%, net income around 33%. And if we scroll down, I want to point out a couple of things that I actually like about this business. Now, to start off, I think it's a huge plus anytime management actually highlights capital allocation plans, because capital allocation is the most important task of management, and they explain it fairly well. Obviously, operating cash flow from our core egg business provides the foundation for reinvestment and returns. So to start, they look for reinvestment opportunities. They look for M&A opportunities. They're looking to focus on the high margin business. And then because of all this, they're looking to sustain dividends and pursue opportunistic buybacks. That's key because remember, when companies pursue share buybacks when the stock is overvalued, it can actually hurt shareholder value. But when they're able to buy back shares at undervaluations, it can provide tremendous shareholder value. And a lot of this is possible because of how strong the balance sheet is with their zero net debt position. Now, one of the things they also highlight in regards to the dividend is that 1/3 of GAAP net income is used to actually pay out those dividends. Now, like mentioned earlier, because they're so reliant on the price of eggs, we see a lot of fluctuations in the fundamentals. For example, look at sales over the last few years. We can see from 2018 to 2022, it stayed relatively in the same range, and then in 2023, we saw a huge spike up, and you can see exactly why. Look at the price of eggs. Look at that correlation. Again, 2024, a slight drop, and then in 2025, another huge jump up, and again, look at the price of eggs during that time period. But as we enter 2026, their fiscal year 2026, again, the price of eggs is down pretty much to the lowest that we've seen in the last 5 or so years. And predicting the future prices of commodities is pretty difficult. And we have seen in the last month a pretty significant sell-off, but again, what's interesting about this is after this sell-off, we just saw the first insider purchase in a very long time. So there you go, those are 3 under-the-radar stocks that have recently seen insider buying. Again, be sure to check out Forecaster down below at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.